Welcome to Frost and Sullivan's Growth Podcast. In each episode, we take a deeper look at the transformative shifts shaping global ecosystems, from industry megatrends and technology innovation to evolving customer expectations. Today, we're exploring from capital to collaboration, reimagining corporate venture capital for strategic growth. We'll unpack how corporate venture capital is moving beyond financial returns, why so many programs struggle to deliver enterprise impact, and what future-ready organizations must do to turn venture investments into engines of transformation. How has corporate venture capital evolved from a financial tool into a strategic growth lever?
CVC has moved well beyond balance sheet investing. Today, it sits at the intersection of innovation, growth, and risk management. The real value isn't how much capital is deployed, it's whether those investments reshape business models, unlock new capabilities, and future-proof the enterprise.
Why do so many CVC programs struggle to deliver lasting strategic impact, despite strong investment activity?
Because access to innovation isn't the issue, integration is. Nearly half of CVC-backed startups fail to scale internally, not because the technology is weak, but because corporations lack the operating models to move from pilot to enterprise-wide adoption.
What does the recent reset in global CVC investment tell us about the direction of the market?
It signals maturity. After years of expansion driven by excess capital, CVC has become more selective and disciplined. Investment levels have stabilized, and strategic intent now matters far more than deal volume.
What structural shifts define this new era of corporate venture capital?
We're seeing fewer but higher conviction deals, a shift from financial ROI to strategic ROI, and tighter alignment between CVC portfolios and corporate roadmaps. Success is increasingly measured by adoption, integration, and revenue impact.
What are the most common reasons CVC portfolios fail to create strategic value?
The biggest issues are weak strategic alignment, slow decision cycles, stalled integration after pilots, and KPIs that focus on deal activity rather than enterprise outcomes like growth, efficiency, and speed to market.
What differentiates high-performing CVC programs from the rest?
High performers design integration into the investment strategy from day one. They balance autonomy with alignment and build clear pathways from investment to product, platform, or operational adoption.
Is there an ideal structure for a high-performing CVC program?
Mid-sized hybrid CVCs tend to outperform. They're large enough to influence strategy, but agile enough to move at venture speed, especially when supported by strong governance, analytics, and market intelligence.
What will separate CVC leaders from laggards as we look toward 2030?
Leaders will shift from capital deployment to ecosystem orchestration, using CVC as a platform for large-scale transformation in areas like AI, mobility, and energy transition, rather than treating it as a standalone investment function.
Thanks for joining us on Frost and Sullivan's Growth Podcast. If today's conversation sparked new thinking around innovation, strategic integration, and enterprise growth, you can explore deeper insights in our latest research on next-generation corporate venture capital, or connect with our experts to assess how your organization can evolve its CVC model for measurable impact. For access to Frost and Sullivan's analysis, competitive benchmarking, and best practice frameworks, visit frost.com or email us at hello@frost.com. We'll be back soon with more conversations to help you navigate uncertainty, sharpen strategy, and stay growth ready.